Right now, the four biggest tech companies in the world are about to spend $750 billion this year, not on offices, not on salaries, on artificial intelligence infrastructure. And by next year, that number crosses 1 trillion. In the next 10 minutes, I'm going to show you exactly where that money is going, why the stock market just went through a violent swing because of it, and, more importantly, 3 specific things you can actually do with this information. Not vague advice, specific moves. Stick with me, because by the end of this, you'll understand something most people watching the news right now completely miss. Let's start with the number itself, because it's almost too big to picture. $750 billion. That's Microsoft, Google, Amazon, and Meta combined in a single year, building what's called AI infrastructure. And according to McKinsey, this isn't a one-year spike. Global spending on AI-powered data centers is projected to hit $7 trillion by 2030. To put that in perspective, that's larger than the entire GDP of most countries on Earth, spent on server racks, chips, and buildings full of computers. So the first question is simple. Why? Why would 4 of the most disciplined, profit-driven companies on the planet commit this kind of money? Here's the honest answer. These companies believe that whoever controls the most powerful AI infrastructure controls the next decade of the economy. Every major industry, healthcare, finance, manufacturing, even entertainment, is being rebuilt around AI systems. And those systems need somewhere to run. That somewhere is a data center, a massive facility packed with specialized chips, working around the clock, consuming enormous amounts of electricity just to process AI requests. The company that has the most capacity gets to sell that capacity to everyone else who needs it. That's the entire game. Now, if this were only about chips, the story would be simple. But it's not. And this is where most explainers online stop, and where I want to go deeper, because this is the part that actually affects your money. The AI investment boom has expanded far beyond chips. It now touches memory, storage devices, servers, cooling systems, and, critically, power generation. Nuclear power companies, construction firms, and industrial cooling manufacturers are all seeing real demand growth because of this build-out. Why? Because a modern AI data center doesn't just need chips. It needs a stable, massive, uninterrupted supply of electricity. And in many regions, the existing power grid simply cannot keep up. This is quietly becoming the single biggest bottleneck in the entire AI industry. Not chip supply, not talent, power. That's worth pausing on, because it explains something confusing that happened just last month. In June, the so-called Magnificent Seven, the 7 largest tech stocks, the ones most tied to this AI build-out, collectively dropped about 12.7% in a matter of weeks. If you were watching the news, you probably saw headlines calling it the start of an AI bubble bursting. Investors were asking a very fair question. If we're spending trillions on this infrastructure, when does it actually turn into revenue? Are we building capacity the world doesn't need yet? And here's what I want you to understand, because this is the nuance that gets lost. The drop wasn't really about AI demand collapsing. It was about positioning. Big institutional investors had piled so heavily into these stocks that any sign of hesitation triggered a wave of profit-taking and rebalancing. Companies like Nvidia, Microsoft, and Alphabet kept reporting strong, sometimes record demand for their AI services the entire time. Then, just days later, Micron, one of the major memory chip makers, posted blowout sales guidance, and the entire AI trade snapped back to life. That kind of whiplash tells you something important. This market is emotional right now. Sentiment is swinging harder than the actual underlying business results. So subscribe if you want to keep seeing breakdowns like this, because this is exactly the kind of noise I'm going to keep helping you cut through. Let's talk about what closed data centers and slowdowns you might be hearing about actually mean, because this gets misunderstood constantly. When you hear that a data center project has been delayed or scaled back, it is almost never because AI demand disappeared. Far more often, it's one of three things. The local power grid couldn't deliver enough electricity in time. The specialized chips needed weren't available fast enough. Or the project was simply overbuilt for a specific moment in the hype cycle and needs to be right-sized. This is normal in any infrastructure boom. Railroads overbuilt in the 1800s. Fiber optic cable was overbuilt in the late 1990s. Most of that infrastructure eventually got used, just not on the original investor's timeline. That's the pattern to actually watch here, not a sign the whole thing is collapsing. Now, here's the part I really want you to sit with, because this is where it becomes useful to you personally, not just interesting. First specific move. Stop thinking about this as, should I buy Nvidia? That question is already crowded, already priced in by millions of other investors, and frankly, too narrow. The smarter angle, the one professional allocators are actually using right now, is looking at what's called the picks and shovels layer of this boom. During a gold rush, the people who reliably made money weren't always the miners. It was the companies selling the picks, the shovels, the supplies. In this AI build-out, that's the power utilities, supplying electricity to data centers, the cooling and water purification companies, keeping those facilities running, and the memory and storage makers, like the one I just mentioned, whose products every AI company needs, regardless of which chip brand wins. That layer is less crowded and often less emotionally volatile than the headline AI stocks. Second specific move. Use hyperscaler earnings calls as your personal early warning system. 4 times a year, Microsoft, Google, Amazon, and Meta report earnings, and every single time, they disclose their capital expenditure plans. Literally, how much they're planning to spend on this infrastructure next. If that number keeps climbing quarter after quarter, that's a real signal that real demand still supports this spending. If you ever see that number flatten or drop 2 quarters in a row, that's your genuine warning sign. Far more reliable than a single scary headline or a single red day in the market. Third specific move. Do not chase this with leverage, and do not treat a single AI stock as your entire strategy. What we just watched in June, a 12% swing in weeks, is exactly the kind of move that wipes out anyone using borrowed money or options to chase momentum. If you want exposure to this trend, the boring, historically reliable approach still wins. Dollar cost averaging into a diversified position, whether that's a handful of individual companies across the layers I just described, or a broad technology-focused fund, spread out over months, not dumped in all at once at the top of a hype cycle. Here's the bigger truth underneath all of this. Every major technological shift in history, railroads, electricity, the internet, followed the exact same emotional pattern. Massive optimism, huge capital spending, a painful correction where people declare the whole thing a bubble, and then, years later, the infrastructure that survived that correction became the backbone of the next several decades of growth. Right now, in July 2026, we are almost certainly living through that painful, volatile middle chapter with AI. The infrastructure being built today, the chips, the data centers, the power plants being upgraded to feed them, is very likely going to be the foundation of the next major economic era. The volatility you're seeing in the headlines isn't proof the story is fake. It's proof the story is still being written in real time, and the people paying attention now are the ones who will actually understand what's happening when everyone else catches up 2 years from now. If this kind of breakdown, cutting through the noise, giving you the actual mechanics behind the headlines, is useful to you, hit like and subscribe to Professor Alpha, because I'm going to keep tracking this specific story, the earnings calls, the capex numbers, the power grid constraints, all of it as it develops. Before you go, one last thing worth remembering. The biggest mistake in every historical boom like this wasn't buying too early. It was panicking during the correction and selling out right before the trend resumed. Understand what you own, understand why you own it, and let the noise be noise. I'll see you in the next one.